pleasure having Tracey Chaffin from Wachovia Capital Partners. Tracey graduated from the University of Florida early 90s.
90 with my master's in accounting.
Master's degree in accounting, and went to Price Waterhouse in Jacksonville, and then with the corporate investment bank at First Union, and has been with Wachovia Capital Partners since 1995. It's a great pleasure to have you today, and she'll take questions at any time.
Thank you. Thank you, everyone. I recognize that I am the only thing standing probably between you and your weekend plans. So hopefully we'll have a presentation today that is of interest to you. Like Dr. Brown mentioned, I am open to questions. Feel free to interrupt me at any time. This is go with the flow. I'm trying to make something interesting for you. Hopefully you'll take home a piece of information you didn't know prior to coming to today's session. And with that, I'm going to take you through my presentation, which I think most everyone had ahead of time. And so you know the agenda, which starts, Dr. Brown gave you a little preview of exactly who you're listening to for the next 2 hours. So there is a quick overview. If I bore you at any time, just place your head on the desk, start to snore, and we'll move on to the next slide. So before I give you a more in-depth introduction to myself, I just wanted to find out today, how many people do I have here that are accounting track students? 3. I am a lonely, lonely person. And then the rest are finance, I'm assuming. Most people in the MSF, or do we have undergrads here as well? Undergrads, got a lot of those. Okay. Well, let me tell you a little bit about myself. And show of hands before I got here today, was anyone planning a career in private equity? Really? Well, I can tell you I wasn't. When I was sitting in your I'm kind of going through nostalgia today because this is my accounting classroom. So I'm going around here in this university today, reliving when I was back here on campus and getting used to the fact that some things have changed. Like, I'm going to call the purple porpoise, but we all know it's not here anymore. So I'm getting used to different building names and different locations. But as Dr. Brown mentioned earlier, I graduated with my undergraduate degree, BS in accounting. I did the 4-year undergrad program, then I did the 1-year master's program. So I actually have a master's in accounting that I got in 1990. And with that, I sat for the CPA exam in the fall of 1990 and passed that, and was on my way to my first job in public accounting. I interviewed with all Big 8, dating myself at the time. There were 8 firms back then, and 1 regional firm. And I selected Price Waterhouse as my firm of choice in Jacksonville, Florida. My client at the time, the premier client, was Barnett Banks. That brings back some memories. And with Price Waterhouse, I transferred up to Charlotte, North Carolina. Again, my clients were predominantly what we used to call FISIP clients, Financial Services Industry Practice. And Nations Bank, now known as Bank of America, Barclays was another name. And I stayed with Price Waterhouse in Charlotte until I was about a senior accountant. And then I got a call one day from a former manager who used to work at Price Waterhouse that had gone over to this company called First Union. First Union was just in the process of starting its capital markets business. So when I started way back then, it was in its infancy stages. And I was one of 7 finance professionals who joined what I'd call the accounting finance team. And to put it into perspective, that same team today is about 200 people big. Just tell you how it's grown there at First Union. Excuse me. So I stayed at First Union for a while, and part of the reason is because when I served in this finance capacity, one of the first units I supported from what I'd say an accounting manager perspective was this group called Wachovia Capital Partners, also known as the private equity group within Wachovia, and of course at that time was First Union Capital Partners, but also known as the principal investing arm of Wachovia, and we'll talk about that a little bit, what that means. But I'm going all through this because I want you to appreciate kind of how career tracks can occur even when you're not really expecting it to occur this way. So I went over, part of the reason I went to First Union is because my husband threatened me that if I actually wanted to have a family, I had to stop working nights, weekends, 800-hour weeks is what it felt like. I actually had to be around to help create the children. So that was the real reason I left public accounting. And went over to First Union and supported this group, Capital Partners, and who had been begging for a controller. And obviously I was one of the first accounting professionals that came in and said, what can I do to help? And I started off as their controller. And when I started, I remember the gentleman who hired me was worried that I wouldn't have enough to do. And the boss that I worked for in that finance group thought I would be bored. And I remember sitting at my desk in my finance role. I think it was my first week of work. And the partner of the Capital Partners handed me some checks and said, here, I need you to make sure these get deposited and the gain gets recognized. And I looked down and I had over $9 million sitting on my desk, and I thought, this business is really cool. I would sit there and thought, I have $9 million plus on my desk. Honey, guess what? Anyways, I deposited. I didn't keep any for myself, which is why I'm still at Wachovia. But anyways, the portfolio from when I started was about $200 million big in terms of assets, and grew at its peak to about $3.3 billion. We started employee co-invest programs. We branched out in some new products. I'll tell you about that a little bit later. And what really happened is my role evolved from controller, kind of just managing a small unit, to CFO, which was really managing a much more complex business environment, different product lines, and obviously a much larger staff. Staff went from just me solo to about 6 more support people. And when I became CFO, part of what happened, if you look at the industry cycle in private equity, was in the late 90s and into 2000, private equity groups in financial institutions were having a huge impact to the bottom lines of these corporations. J.P. Morgan Chase, Wachovia, Bank of America. And all of a sudden, these little shops that nobody really paid attention to became the extraordinary focus of what can you do for me? How can you make more money? So we went through massive regulatory changes in terms of more scrutiny from Federal Reserve and OCC. We had more demand to get money out the door, and all of a sudden we started deploying hundreds of millions in a year. I mean, like close to billions versus just maybe 100 or 200. And it was during this era where everything kind of ballooned that I was promoted to partner. I was one of the first, 2 things. First woman promoted to partner within Wachovia Capital Partners, and I'm the only partner who is not an investment professional. And so as we talk today, one of the things I want you to appreciate is I'm going to give you an aspect of private equity from the middle office, not as somebody who is out there doing the deals. So to give you an appreciation of where my role is involved in working with professionals who are associates, partners, principals, etc. And one of the things that happened along my career as CFO was this thing called Sarbanes-Oxley, which I absolutely despise, because it added a lot of work and it tied my hands behind my back, because all of a sudden you could not have a CFO in a business unit, because all of a sudden we became evil beings that did nothing but divert money and do inappropriate things with shareholder assets. So I had a choice, and my managing partner had a choice, which was I could be realigned back to that finance group that I used to be in and keep my title as CFO, or I could kind of work around the system and let other people actually do journal entries and do some wires, change my title, and still manage the entire business. And that was the track we opted for. So my title got changed. I'm now Chief Administrative Officer. I like to think that's a fancy title for jack of all trades, anything but the deal person, grunt person, give it to her person, here's somebody who can handle it person. I really cover all aspects of the business besides the frontline investing. And when I talk today, I want you to appreciate some of the differences between being in my role, which is more middle office, and being a frontline investment person. So we're going to advance to the next page, I hope. And next I want to give you an overview of Wachovia in and of itself. So you can appreciate kind of when I talk about principal investing, what the heck that means. And also I want to give you an overview of Wachovia. I know you all have probably seen this presentation ahead of time. I want you to appreciate there are different tracks, different areas of opportunities for graduates to have employment, and you need to make sure you are in the right track. And sitting in my chair, while I don't do the deals directly, I'm somebody who works with associates, with VPs. A lot of times, for my accountants in here, there are a lot of times when the deal people come to you and say, "I'm modeling. How should I think about this when I'm putting this into a balance sheet or an income statement?" That has been scenarios where my role interacts with an investment role. So let's figure out exactly where the heck I am in the scheme of Wachovia. So looking up on the chart here, Wachovia really has 4 lines of business. And does everyone in here have seen the presentation that has the descriptions? What I wanted you to appreciate, which is what I said before, is there are opportunities for every person in this room in every single one of those boxes. But what I really want you to appreciate is that these are totally different tracks. The 3 boxes on the left versus the gray box here, the corporate and investment banking box is the deal box. That's when you have recruiters come here from Wachovia. There's 2 types of recruiters. There's the corporate investment banking recruiters who are looking for analysts and associates who want to be doing deal work. Then there's the general bank, wealth management, capital management group who also have opportunities available. They tend to be labeled as general bank opportunities. And those are also tracks where they're looking for analysts and associates but doing work for Wachovia as an institution, i.e. our treasury group. We have a group of professionals that are out there every day hedging, borrowing, doing analysis to figure out how best to balance the balance sheet, so to speak, managing our assets and liabilities. So if you talk to a recruiter from that side of the fence, you're actually working for Wachovia, for Wachovia's benefit. If you're talking to a recruiter in corporate investment banking, you're actually talking to making Wachovia's benefits by doing deals, creating revenue. So I want to make sure people were kind of clear on that. And there were some descriptions in the presentation materials just to make sure people understood what the different boxes were. General bank, the way you think about it is, you see your branches of Wachovia. That's obvious. Wealth management is really, dealing with how to manage our wealthy customers and their assets. Understand there are opportunities there. They look for people who can help, advisors, telling people how to invest their money, doing analysis on their portfolio, managing personal wealth. Capital management is more of the trust services, 401k type management, pension plan management. Our evergreen investments is there. That's our brokerage firm. That's another, what I'd call avenue if you're interested in more brokerage type career track. And then corporate investment bank, which is what I already mentioned. And what I wanted you to see here is, one, the way the revenue cuts. You can see based on a customer's revenue base, pretty much they have to get over $250 million to get into the corporate investment bank target frame. And I also wanted you to see the different industry focuses because, as you can see, healthcare, media communications, technology services, financial institutions, keep going down the line, all different tracks, all different opportunities. And in Capital Partners, we actually have our deal teams broken down by industry groups to focus on opportunities within each of those lines of business. All right, so we got into corporate investment banking. Now I'm going to take you down another layer. And you can see here we have 6 major lines of business. And principal investing is the box out here to the right in gray. That's where I'm going to be talking about today. What I also wanted you to appreciate off this slide is the boxes at the bottom. When you hear about investment banking, we're pretty much talking about the mergers acquisition box, the financial sponsors group box, and the corporate finance box. What I want you to appreciate is that those are the boxes when I talk about investment banking. Mergers and acquisitions is pretty much what it says. They're an advisory group of professionals who help clients looking to buy or sell businesses. Financial sponsors group is a group of professionals that does nothing more than go to other private equity groups to mine for capital markets type business. And they work very closely with principal investing to source deals back and forth. And then corporate finance is basically the debt provider for most cases in our deals, and I'll talk about that a little bit later. I'm not going to really cover the other fixed income and equity and global research side of things. What I do want you to appreciate is I do know there are recruiters coming to this campus in the next week and a half, something like that, and they are focused on job opportunities in that fixed income world. Real estate capital markets is one of them, and I think maybe real estate capital markets and something in fixed income. So I want you to appreciate that depending on what your interests are, if you're more research-oriented, maybe bonds, things like that, you'd want to get in touch with those fixed income type recruiters. If you're more on the mergers and acquisition, private equity, corporate finance side, you'd be more interested in talking to somebody who is recruiting for the investment banking side. So just hoping that'll be clear to you if you start to hear of people from Wachovia coming to the campus. All right, so the gray box that you saw earlier, Wachovia Capital Partners, is the brand name of the principal investing arm within Wachovia. And my job sits at the box there called portfolio monitoring. What that basically means is we are the group that once the deal is done, it's ours. We do everything thereafter. We usually help. Did you have a question? Okay. We usually close the deal. We have to monitor it from a portfolio perspective, compliance, any kind of oversight bodies, internal audit, finance, etc. That all falls into our world. Our job as a group is to handle what I call the kudzu, so that our deal professionals can be out there doing the deals. We handle all the administrative work behind the scenes that's a mandatory requirement of being part of a bank holding company, so that our deal guys are out there on the front line making money for the institution.
I'm sorry, can I ask you to back up just a little bit? You
Sure.
were talking about the different different tracks that students could choose. Can you go, I guess here you were talking about fixed income or M&A and things
Yeah.
like that, and you were saying, well, you want to go research, do this. Can you talk a little bit about, particularly for the undergrads, but even for the MSFs, how do you know whether you're an M&A person or an equity division or fixed? I mean, what skill sets? If you're good at this or if you're bad at this, for God's sakes, don't do this.
Yeah.
Can you talk a little about that?
Yeah, I would tell you the honest statement is I bet you don't know right now, which is why part of the reason I'm here trying to explain these things to you is it behoove you to learn more about the different types. Has anyone seen the postings that came that are out there for Wachovia that the recruiters are coming for? Have you seen them?
Yeah, they've got a skill set list.
Yeah, they show you a little bit about what's involved, modeling, debt versus, a mergers and acquisition side, that is more selling yourself. We are out there trying to get business to get people to allow us to handle their merger or acquisition of our company. So that's more of a sales-related type function, whereas, if you're in corporate finance, you're the one who may be putting together the debt package principal investing has gone out and found a customer who needs $100 million of capital. And we've done an analysis that says the best way to structure this company is $90 million of debt, $10 million of equity. We'll handle the equity. Corporate finance, you handle the debt side of things. Figure out how we can do it. Is it a term loan? Is it revolvers? Is it, some kind of other structured? And so what I can really say to you is try to do some research around all the avenues. My personal opinion is you can't go wrong anywhere. Because the one thing that I like about a Wachovia is a very proactive corporation that says, if you get one box and you don't like it, we've invested a lot of money in creating your talent, use it in another box. Okay? So one of the things you're going to hear of is principal investing recruits probably 60% of its associate pool from the boxes down here. And part of it is getting in. I was saying this at lunch. We just hired a woman who was University of Florida graduate, and she was recruited by Bank of America to go what she thought work in their corporate investment banking. She knew she wanted to do the deal. And what she realized is she got on a management program that put her in the behind the scenes at Bank of America, working for Bank of America. And she said in a year of working, her phone probably rang once. Actually, she said her phone rang 3 times, but twice it was the wrong number. So she was like, this is not what I signed up for. I want to be in front of customers, okay? And one of the things you need to assess in yourself is, what are your strengths? Do you like interacting with new people and getting out and being confident and doing deals? Or are you a little more introverted? Is it uncomfortable to be in new settings that maybe you'd rather be, behind the scenes, doing the same interesting work, but you're not out there doing kind of the customer interaction? Those are ways you can kind of figure out. I personally think, the world's your oyster. Try to do some research in terms of understanding what each type of deal is. I personally think it's hard. When you haven't actually gotten out there and doing it, it's hard to figure out exactly which box to be in. But that's one of the things I think is interesting about Wachovia, is you can get in a box and get some training, and there's good opportunities for lateral moving around if you kind of get in there and say, little different track. Now, if someone comes out of it, I saw some hands raised earlier who said, hey, I'd like to try to get into private equity. That's something that I want to be in the mergers, acquisitions, financial sponsors, or corporate finance. And I'd actually say corporate finance, mergers, acquisitions. That's where you want to be, because that's where most of our talent pool comes up from an associate perspective. And the reason why, it's not that one box is better than the other, but the reason why is because, and I'm going to talk about this later, it's the synergies between the groups and how they end up interacting. So a mergers and acquisition professional, he or she goes out, finds the company that's looking to be sold, and has to go match up a buyer, and that's great when they find a buyer, unless the buyer has no money, and they need to finance it. So guess who they go to? They go to their corporate finance box, and they go to their principal investing professionals and say, we need some money to buy, this buyer wants to buy this company, needs $100 million in capital, figure out a way to do it. So that's where, I talked to you about investment banking. That's where the synergies are as it relates to principal investing. Okay? Did I answer your question on that? Okay, good. All right, so we're here. Dropping down to the boxes, I know I had a slide, so I'll jump ahead a little bit to my next slide. Wachovia Capital Partners is kind of broadly defined, is the equity and mezzanine capital investment group of Wachovia Corporation. And so I said this in my lunch meeting. This is my key phrase. Anyone know what mezzanine is? Be honest. Yes? I sure as hell didn't. When I joined Capital Partners, everyone kept talking about mezzanine. I kept saying, what? All I knew is like, is that middle layer in a theater somewhere you sit? I'm like, what is mezzanine? So this is my lesson learned, so you'll sound one step ahead of your competitors when you're out there competing for positions. Mezzanine securities, if you think about a capital structure, you have debt and equity, right? Common stock's kind of your bottom layer, nothing special about it. You got senior debt up here, so in the event your company goes sour, they get their money back first. Mezzanine is nothing more than the middle tranche of capital. Subordinated debt, which is nothing more than a fancy term of saying the debt that's subordinated to the senior debt, right? Or usually a preferred equity, which means you're on top of the common, right, because you have preference. And I'll go through what each of those means at the end of the day. But so when you think about what does Wachovia Capital Partners do as far as being a capital provider, we don't provide senior debt. That's outside of our job description. We are strictly that lower layer, equity and mezzanine. Equity usually referred to or thought of as, the common or preferred down at the bottom, and mezzanine usually is defined as subordinated debt or preferred. And so we have two lines of business here. We have direct investing and we have indirect or fund investing. I like to think of those, the analogy I always use to people to explain what's the difference between that is direct investing is when we actually go out and provide capital directly to an operating company. Indirect investing is when we give capital, we commit capital to another private equity group who then pools the capital with other private equity dollars and then goes out and makes investments in operating companies. That sounded really complex. It's the same way as saying this. If I went out and bought $1 of Wachovia stock tomorrow, I'm making a direct investment in Wachovia. The fund investing is exactly equivalent to going into a mutual fund that goes out and buys $1 of stock of Wachovia. So I'm not directly invested in Wachovia, I'm indirectly investing. Same concept here, except it's not public securities we're dealing with, it's private equity. And then our fund investing is broken down into another two layers. So we make investments into these third-party funds. And then what we've also done is we've created a primary fund-to-funds vehicle, which involves taking some of those, or taking fund investments, putting them in a fund, and then allowing people to invest in that fund, even outside of Wachovia. That is a product line Wachovia have not gotten into. A lot of our competitors have. That product line starts in 2007. The secondary fund-to-funds product is we had investments up here in the fund portfolio, and so they've been on our balance sheet for a couple years. We know how they're performing. We dropped them down into a special purpose vehicle and allowed other investors to come in and buy on a secondary basis, meaning they were already owned by us, now they're owned by a second group of individuals. And you can see why my job is to oversight all of the mechanics. So they go out and they make a fund investment, and then they're done. Now somebody has to create financial statements, monitor capital accounts, do reporting to the client base, create presentations, create marketing materials, all that. Now, I'm not doing that solo. There are relationship partners who are doing the kind of the day-to-day, but you can see I want you to appreciate what the portfolio monitoring group does in relation to kind of people who are out there frontline.
How does the governance work in a setup where there's 5 private equity firms contributing capital and then you take a direct investment in the firm? Somebody has to make the decision.
Make the decision to make the investment?
Yeah, to make the investment and also any ongoing operating decisions or activities that are to enhance the firm's value.
Well, there's two things from actually making an investment. So making a fund investment, usually you have a corporate governance that involves investment approval decision making. Capital Partners has the authority to make up to $25 million investments without going to another individual. We have a commitment committee of 4 senior partners. They decide to make an investment and up to $25 million. It's totally up to their discretion. When it goes beyond that, risk managers start to get involved. Senior executives have to start getting involved, et cetera. Now, from a corporate governance, once you make the investment, and let's say I'm an outside investor, usually it's the way as an outside investor you keep track of your information is through quarterly reporting. So you get quarterly reports giving you updates on the portfolio, tell you what's going on, what are your returns. You get audited financial statements. It's almost mandatory. That's how most people, from a governance perspective, in terms of what's going on with a fund. Now I've put my money in. Now tell me what's going on. It's all about reporting. And one of the things that's happening in the industry right now is there is no formal governance in terms of somebody saying this is how you got to present the information. And that's one of the things the industry is trying to govern is standardized reporting, because what we found is if you had three funds all invested in ABC company, guess how many valuations you might have? 3 totally different. One thinks it's 0. There was a downturn in private equity, .com, bubble burst. A lot of venture capital went down the tubes. And it was almost comical in a not really funny way, but you had the asset managers who said, .com company's toast, it's 0. You had the next manager say, .com company is still worth costs. It's still going to make it, even though we've just fired the CEO and it's trending below in its revenue. And Fund 3 would have it written up, because it's still going to be the winner at the end of the day. Multiples are crazy, and that's some of the challenge that's in private equity. And that is one of the roles of the associates in our group. Our associates are responsible for creating valuation analysis that supports what we carry our investments on the books of Wachovia, and we as a group have to justify our carrying values to other governing groups like finance, like risk management, to kind of justify, hey, what's on the books is actually fair value, because our reporting is at fair value under investment banking guidelines.
Tracey, can you talk a little bit about where we are in that cycle today? I mean, I've read stuff that
Yeah.
says we're in exactly the same.
We are. I'm freaking out because.
Yeah, how does that change your job?
Yeah. Let me tell you what. Principal investing. We've been together as a group since 1988. Okay, and we could do no wrong. We were the group. I've told you we were at one point we were only 15 people big. I think at our highest we got to about 40 people big, and you got to remember when I give you those numbers, I'll say 25% at a minimum, maybe 30, were either back office or administrative professionals. So when I give you those numbers, think about how many people are true frontline. And we were creating, $500 million of revenue a year. Huge. We are probably the tiniest group within corporate investment banking. And there was a time frame there we were creating half the revenue base. And then what happened was during the .com era, people lost their heads. We would see companies doing IPOs at multiples that were just, there wasn't even a revenue base. It was just like the whole craze of new technology and what was going on. And so you know what happened? And this includes us as investors. Everybody went out there and started investing dollars at these crazy multiples. People just got crazy. Dollars were going out the door. Private equity groups had money to invest. There were a huge overhang of capital. Everyone sent their money out the doors. We had a mandate from Wachovia in 1999, as many dollars as you can get out the door. And because we were making so much money, everybody said, oh, this is it. This is the place to be. Put your money in there. And then the bubble burst, and we had hundreds of millions of write-downs. And we weren't alone. The one thing I would actually say I thought our group was going to get shut down at that point, even though the only thing that saved us was our reputation. There's two things that saved us: our reputation and the fact that when our CEO looked out there at the rest of the world, every other financial institution was going through the same pain in their private equity. So it really was a lot of smart professionals all kind of getting caught up when the bubble burst. And I'm telling you, I thought we were going to have heart attacks going on. Every partner was managing way too many deals. All of them were blowing up. Companies were going under. We're running in there trying to, create ways that companies could still perform. And we are still, if you can believe it or not, we have some investments still in our books that we completely wrote off that are turning around and generating gains for us today. And that's the one thing I can tell you about private equity is it changes by the week. A deal worth a 2x one week is worth nothing the next. I mean, things change unbelievably fast. And part of the reason they change fast is it depends on the craziness sometimes in the marketplace. So to your question of where are we in the cycle, all right, we were like this in 1999, 2000, and the bubble burst, and 2001 and 2002 was unbelievably ugly. Multiples came down, valuations came down, companies crashed, and those who survived the cycle kind of made it back, and we came back into an uptick. Things normalized. I'd say by about 2002, 2003, we're past it, kind of coming back to the uptick. And if you ask me where we are today, we're starting to see those crazy multiples again. Crazy multiples, people have money to invest. There's like $1 billion of private equity dollars out there that managers are trying to get out the door in ways to make money for their investors. And they can't find places fast enough to put it. So you know what they do? You know, normally private equity, you'd say, I demand a 25% return on my equity because it's a high risk and I got to get my money back. And a lot of times your money's sitting out there making no money until the end. So if you're going to sit out there for 5 years making no money, you better get a decent return to make it worth that risk. And, you know, it's sitting out there today, and what firms start to do when they realize multiples are still getting high but they're trying to get money out the door is they settle for the lower returns just to get it out there. And one of our lessons learned at Wachovia was diversification. And we realized private equity cannot be the sole breadwinner for Wachovia's corporate investment banking platform. It needs to be a contributor to it, but not the sole. That was one lesson learned. And number two is do not compromise your principles under any circumstances. And I mean that in terms of our stated rate of return is mid-20s. Don't do the deal if that's not what you can return. And that means walking away sometimes. And sometimes you walk away from a good deal, but more times than not, you can walk away from the bad deal. And one of the things we had to face from a valuation perspective is, you know, getting back to Dr. Brown's point, is we don't have corporate governance over these private equity funds. So, you know, they can go out there and invest money in whatever they want. When you're making those investments, you better make sure you're dealing with managers and professionals that have a reputation you can trust in terms of making good investment decisions. You know, groups that can weather the changes in the cycle. And, you know, that was one of the things we saw where the fund managers were going out there and starting to settle at one point for, you know, low teen type returns. And we said we won't do it. Our mantra is we'll put less dollars out the door in good deals than more dollars out the door in blasé deals. Mm-hmm. Yes?
Do you have deals like certain size or like certain, like what's your cut or like as far as like how much money you invest in? I don't know.
We tend, and I'm going to talk about that in a little bit, we tend as Wachovia to, our perfect point is about 25 million, probably 20 to 30 million is where we like to invest right now. When I first started the group, our investment sizes were 5 to 10. And what we're realizing is to have relevance with our customers and being able to have more control over our investments, we have to take bigger chunks. So right now we're at about a $20 to $30 million investment range on average. Once or twice we've gone over 50 million.
Do you ever make exceptions like smaller for like great deals? You know, you just
Absolutely.
you strictly set like a pattern of investing or whatever.
Nope. We try, one of our marketing tools is being flexible, opportunistic investors, which means we have our kind of set rules of thumb, but when there's that unique situation, I mean, if it took 50 million and we think the management team's awesome, we think the product that's being offered by the operating company is just unique, there's ability to expand in the marketplace, you know, we'll make the investment. And we've done that. What we've done sometimes is we've helped the company grow, and then they get to the next level and need more capital, and we'll invest more money at that point. And we've done that. That's a great example of where a manager has kind of proven itself. You know, management team gets out there, they're kind of small potatoes, and that's part of what you're checking. Can they grow? Because we've had a lot of times where once you start getting some scale, management teams start falling apart. They can't deal with the size. And nowadays you get a company that goes public through an IPO. I mean, that's a whole other set of rules and sophistication as it relates to Sarbanes-Oxley and things like that. And you got to make sure you got a team in place that can do the marketing. I can tell you, sitting here as part of a public company, the scrutiny is unbelievable. And you are on display. People look at every, analysts are looking at every number that comes out of your business. They want to understand where it comes from, what's recurring revenue, what's one-time pops. And, it's challenging to have people at the top who can grow a business and have vision and still be savvy marketers for when they're sitting in front of the analysts and talking about their company. So, did I answer your question in terms of size, Dr. Brown?
Before you got off this slide, don't make this too personal, but I'm interested in performance. So, what metrics you would use, what metrics you're evaluating from, so maybe to make the question more narrow would be, when bonuses are handed out to people of Wachovia Capital Partners, is there some measurable that you use and what is it?
Yeah, I'll make two comments to that. There's one word, IRR, or I guess 3 letters is what I should have said. IRR, IRR, IRR. That's all anyone cares about. And the reason I say that is, so you talk about compensation. Has anyone ever heard of the term carried interest? Yes? Carried interest is a terminology used in private equity, which is a fancy way of saying your share of the gain. So if you're out there, if you have an investment and it's $100 million and you double that, so you get $100 million, on average, private equity groups get 15 to 20% of that. Okay, so that's $15 to $20 million of compensation to a handful of professionals. But you don't get it unless you have a minimum return rate, which in our case happens to be 8%. Doesn't sound like that should be too hard, right? Make 8% if I'm targeting 25, which is why you got to do good deals. You get enough junk deals in there, which we did in that downturn era, guess what they take home? 0. But you do good deals, and you're taking home millions. And that's the incentive of private equity. And one of the things we do at Wachovia is partners have to co-invest with Wachovia into all the deals. We have co-investment plans. That's another aspect of what I manage. So the theme behind that is if it's good enough for your dollar, then it's good enough for Wachovia's dollars. So we ride every investment with Wachovia.
Just to follow up on the IRR, that includes market, valuing the...
That's right. Now, for us, compensation-wise, you have to get it into cash. You do not get you. That's right. And there's different ways. Now, to your other point, which is there is the carried interest plan, which is a direct incentive plan, but then there's year-end bonus plans. Okay, that's where the associates get compensated from, right? Because only the partners, you got to work your 10, 15 years in private equity to get the privilege of being in this carried interest plan. The associate VPs and all that who are working their way up there, they get bonused through a year-end incentive plan. Now that is based off of what have you done for me this year at Wachovia? What was your bottom line? What were your expenses? What deals did you source to those other boxes? What are you doing for Wachovia? And we'll help figure out how we're going to slice and dice the pool at the end of the year. So,
Back to the question Jason asked earlier about the private equity cycle. What percentage of your exits are in public markets, and what percentage would be sales, private sales?
I don't have exact percentages, but I'd tell you 10 to 20% IPOs, the rest sales. Sales is the name of the game. And you know why we like that better? IPOs are great, but you end up with a boatload of public stock that you can't move because you own too much.
Just as a follow-up, as a direct investor in that capacity, would Wachovia's investment banking operation typically be the lead manager of an IPO of an investee?
Are you talking about like in terms of an underwriting practice?
Yeah.
Yeah, one of the challenges we have as a private equity group is we're sitting there as an owner of a company, right? And so if the company wants to be sold or wants to go public, that involves another box, right? It either involves our equity underwriting group or it would involve our mergers and acquisition group. And a lot of times to protect our investment, we sit on the board. And there's a conflict of interest that comes there. We actually, because of compliance rules, Sarbanes-Oxley, we have to dismiss ourselves from the board and make it a completely independent decision of the board minus us.
One last question. Something that I was talking to Dr. Grant over is, just, vis-a-vis the conflict of interest. How many deals, direct investing deals, would Wachovia, the bank, be a lender to?
A lot.
Okay.
A lot.
How do you address those conflicts?
We address them through our compliance group, but you got to understand, and we're getting ahead a little bit here. Did anyone see the page where I talked about one-stop shopping? That's what we're selling. Come to Wachovia. You don't have to go anywhere else. We'll figure out the financing of your company, and we'll get it done for you. So it's not hard for us to be a debt provider and equity provider at the same time. But if anyone has done their security studying, you got these things called Chinese walls. Private equity shall not talk to the debt. And trust me, this is a grounds for dismissal at Wachovia if you're caught doing it. And there are, just to tell you how serious they are about it, principal investing's on its own floor. And there's a little bit of space there where every once in a while, somebody else could come sit on the floor with us. You cannot, they usually, we have a lot of times we're restacking the building, moving people around, creating synergies. And principal investing continues to sit in the same space because of Chinese walls issues, because nobody can even sit on our floor that is on the other side of that wall. And that's how, and we have actually had problems where, we've had it where one time we were selling a company and Wachovia was providing the financing to the buyer. So we were the equity seller, and our corporate finance group was the debt provider for the buyer to come in. And one of the outs in the deal was you have to raise enough debt by X date, or we can call this deal off. And that was our syndications group. So they went out and they were short, I think like $15 million of debt. And the deal fell through because nobody was talking on the other side. And so we were furious as an equity group that, we just lost our $80 million gain because our senior debt guys didn't get it done over on this side. That was one of those lesson learned, like get it done when we're sitting there with an equity position. And the moral of the story is they turned around and ended up raising the rest of the money. And the sale eventually went through, but it was 6 months later. And we still got our gain. But my point to that was to say how seriously we take the Chinese walls of issues of nobody's talking to each other, and we make sure of that because it only gets you in trouble with the SEC, compliance, Fed, all this other good stuff. Okay, so I'll keep moving on here. I think we went through kind of our different product lines. We went through that. This page, I'm not going to spend a lot of time. We've probably gone through most of it. The only reason I put all these statistics in here was to kind of give you a feel of what size of a firm I work for. Where if you look at the 5 and 6 bullet down there, we have about $900 million in funded direct equity and about $900 million in funded right now funds, and then there's another $500 million in uncommitted. So we're managing right now about a $2 billion portfolio on a committed basis, and you can see there of if I referenced earlier that at one point we were $3.3 billion. That was during that phase I told you, the dot-com phase, where it was put all the money in private equity. That's how we make our money here. We learned that lesson, brought the portfolio back down, and now we commit from a funding perspective, 250 to 350 million of direct, and then another 100 to 2 million of fund investments. And the other thing I wanted you to see,
You have the cumulative IRR there. Does that include your down period?
yeah.
So it's usually actually probably greater than that then?
It was like 35% before the down. Actually, at one point, I think we even got up to 40. But I would tell you, partially that was crazy valuations. And if I broke that out for you by year, 1 year, 99 is negative, like by 1-something%. And that portfolio is still going. Our goal is to get it at least to 0. But 99 and 2000 are 0 carried interest years, and you'll never see those are 800 million in one year, and I think it was about 600 million in the other. We went right back to being normalized again of 200, 300 million a year, which is a little more reasonable for us. So, and that's pretty standard. That's exactly where you should be in the private equity world. And the only thing I'd caveat to that IRR, that's just the direct investing side. The fund portfolio is the funds that we have invested as a group. It's about 13-14%, which is not bad, but not great. I think that will improve over time because we really, when we did write-downs as an institution, really took a hard look at our portfolio, and we're benefiting from some recoveries where, that's the one thing I'd tell you is in private equity is the deal isn't dead until the company is. So I might have something on the books at 0, but as long as there's a company out there still working, there are relationship managers out there spending their time trying to get those dollars back for the institution. So, and that's been one of the challenges. And that IRR is a result of a lot of smart investment professionals working really hard to recoup from the .com era. And the only other things I wanted to kind of point out on this slide, just to differentiate capital partners.
Yeah, I was about the IRR. For the partners, wouldn't it be even greater because they would be investing some money into the fund, right? So they're getting that IRR, but on top of that, they're getting a carried interest. So for them, it's actually much higher than 20%. Is it?
Yeah, the IRR I'm showing here is a true IRR on the return of the investment. And because you could say, Wachovia gets, let's say, I'm using round numbers. Let's say Wachovia gets 80% of the dollars and we get 20%. You're still, overall, it's still getting a 25% IRR. But yes, I'm sure on a personal investment basis, you're getting something higher on your dollars there.
You say it's 35% or?
The honest answer is I have never calculated it. From that perspective, it's about the number in your K1. It's not about the IRR anymore. It's cash on cash. How much money did I put in? How much cash did I get out? Do you ever put money into something and then say, oh, what was my IRR on that? Or do you just say how much? I put in $100 into Wachovia stock. I got back $200. All I'm focused on is I got a $100 capital gain, not necessarily that it's a 10% IRR. So the honest answer is I've never really tracked. But your point is probably correct in some regards in terms of return on individual dollars. So the bottom two bullets here, what I just wanted to point out is just what makes Wachovia a little different from some other firms. We don't have to do any fundraising. We invest Wachovia's capital. That's our job. Some other financial institutions that have private equity shops take capital in from outside investors as well, and then invest that alongside their financial institutions' dollars. I talked a little bit about doing a fund of funds. That's dabbling in a little bit where Wachovia will commit dollars to the fund of funds, and so will some of our CMG clients. They'll do that, and we'll manage it all together. But right now, we do not have to go out and do fundraising, and that's a whole other aspect of the business I'll touch on a little bit. But making sure you're clear, there's pros and cons to different types of private equity setups. One of the pros of being in an institution like Wachovia is our guys don't have to go out every year and try to raise money to invest. They get Wachovia's money every year. We get an allocation from our asset liability committee, and they say, you have the ability to invest up to $350 million on a direct basis and $200 million on a fund investment basis. And unless your individual investments get above a certain threshold, you're free to manage the business accordingly. And the last bullet I just wanted to point out, this is just going back to size. 21 investment professionals, 5 portfolio monitoring professionals. That's my world again. it's a relatively small shop that has a relatively important impact to the bottom line of Wachovia. And that's one of the things, God bless you, that's one of the things I thought was, that attracted me to private equity was, going back to my example where I had the $9 million of checks on my desk, was sitting in my accounting chair, just handling the journal entries. I thought it was amazing to watch $5 million go out the door and sit there and do nothing, and you don't really see this is sitting in an accounting chair. You didn't really see anything going on, and the next minute somebody's saying $25 million is coming back. And, it's a 5X. It was watching that phenomenal gains, and that's some of the uniqueness in private equity. It's the magnitude of the gains and the revenue that can be created off deals. But don't think that isn't the result of some very impressive investment professionals working side by side with company management to make that happen. Getting to our next slide here, which I know we touched on this just for a second, but what's the role here, this part of this one-stop shopping concept? I said earlier that Wachovia has a desire to be kind of the one place you need to come to finance your business, or your acquisition or your growth or whatever. We have created a comprehensive platform that provides a myriad of products, and this kind of goes beyond corporate investment banking. It's a myriad of products in corporate investment banking, and then also at a general banking level, wealth management and capital management perspective. Principal investing, though, and we touched on this earlier again, part of our role is to create synergies with our other product groups. And we mentioned the mergers and acquisition and corporate finance. If you remember, I mentioned financial sponsors group. Financial sponsors tends to bring more business. Their whole goal is to go out to these private equity groups, these other ones that we're investing in, and guess what's happening out at those shops? There's portfolio companies who are looking to go public and do recapitalizations and liquidate owners, and you name the product, it's out there. The financial sponsors group goes out to other private equity groups, finds that business, and generates it for the rest of capital markets. Mergers and acquisitions tends to be, again, what I mentioned before, companies interested in buying or selling a portion or all of its company. We may be the seller, and you got the Chinese walls there, or we may be a source of capital that the mergers and acquisition group comes to principal investing and say, hey, we got a company that's looking to raise $100 million. Are you interested? And everything is done on an objective, standalone basis. So even though mergers and acquisitions group may have this client who's looking for capital and they refer the deal to principal investing has to make its own independent business decision about whether or not we invest in that company. There is not well, you're doing the M&A and you're Wachovia, so we have to do the private equity group. That's one of our governance points as far as everyone getting to work standalone.
One of the things I've noticed about the decentralization that's been going on with corporations and how you've got different business units and they're responsible, like you said, for returning a certain number to corporate or headquarters or whatever, is that oftentimes when you are just solely working within your own business group, and even though you're synergizing with them, mergers and acquisitions or wealth management, sometimes Wachovia as a whole may lose out. Has there
true.
been any research done to see if there are dollars that are being, not taken because you're making individual decisions instead of whole?
Well, my answer would have been yes, given the example I gave where we had corporate finance on one side and equity on the other, and they made their own independent decisions, and the deal fell through for 6 months, and we had to scurry to kind of revive it. You have that risk. I'd tell you more times than not, though, the synergies of having the one-stop shopping overrides the risk of potentially losing out because we're doing independent decision-making. The other thing I'd tell you is the independent decision-making is mandatory. The Chinese walls I talked about again. I cannot sit there as a private equity provider and go talk to my corporate debt like, well, what are you doing? What's your valuations? And think about a mergers and acquisitions. Sometimes our M&A group is on the sell side, and we're bidding here. Our M&A group can't say, well, Morgan Stanley just bid X valuation, so if you can come in a little higher, you'll get the deal. That's a conflict of interest. You know, they have to operate standalone.
Wachovia, along with some other FDIC banks, have recently started getting into a little bit more sophisticated debt products, like type of securities that we mentioned before. I think Wachovia had a product called WITS, or WITS that they had floated out there.
I think I know what you're talking about in our fixed income world.
Wouldn't that create a situation where it's harder and harder for the Chinese walls to, when they're creating debt products that you could use more in the private equity world? You're getting into that. Does that create more conflict now than it would have in the past?
Well, I would tell you, you know, the more complicated every transaction gets, the more complicated the compliance aspect of it gets. And so, even though we actually have compliance groups. Our phrase is there are groups that sit on the wall, who watch both sides to avoid the conflicts. And my only comment to that would be is we put policies and procedures in place to make sure the conflicts don't arise. For example, if I'm a private equity investor and the M&A group is pitching to the company to do the M&A work, I'm off the board. I recluse myself from making any kind of voting decision making so that it's not perceived in any way. Even if I'm, you know, the nicest person in the whole world, someone could say, hey, Wachovia only got that job because, you know, ABC person from Wachovia was sitting on the board. Now, the one benefit I can tell you get is, as sitting there as a board member of the company, you could encourage the company to at least allow Wachovia to pitch. That's where some of the benefit comes in. So your point about the debt products and conflicts of interest, absolutely. Every time we get into a new product line or, you know, where there's debt equity type provisions, there's always a risk that you're going to have some increased complications as far as compliance monitoring and conflict of interest. And I'm telling you, you'd be amazed at infrastructure with Sarbanes-Oxley and the way it's grown. You know, some of the biggest groups that have exploded from a hiring perspective at Wachovia have been the compliance, the legal, the internal audit of just monitoring that kind of activity. Yes?
Is it possible to walk across certain personnel on the other side of the Chinese wall? Particularly, say, a research analyst to help them share their expertise in a particular industry?
Are you asking me in terms of, hey, I've got a job here in the research group, and now I'd like to get a new job over here?
So, say you work on this deal, and say maybe the private equity group doesn't have personnel to, you know, expertise on that particular industry. Is it possible to walk across, say, a research analyst from the other side to help you guys on that deal?
That usually does not happen, only because research is one of the, it depends on, if I came to you and said, could you give me some information about the media communications industry in general, that's really not a problem.
Other banks, particularly like investment banking, where they can walk across research analysts to help them on their deals.
We do not have research analysts help us. We could utilize research, industry research to provide data for us on our deals, but the only time you really get into a problem is if I came to you to talk about a specific company that you could be researching. And all I'd say is, you know, everything's about perception. So if there's even a perception, you know, you just happen to be, while I'm asking you about media communications research, you just happen to be working on the company that I'm looking to put equity in, and you've just done all the, you know, analysis behind the company, could probably give me some decent information. Even though I might be coming to you just for media communications data, I would tell you doesn't look good. And that's how we manage. That's how we manage some of that Chinese walls issue. Is you don't even cross the wall if there's a perception, not the fact, but a perception that it's inappropriate. Don't do it. And if you have a question, go get somebody on the wall and see if they can, you know, we do that. We go to a compliance officer. Hey, you know, we know so-and-so over in research has done some industry reports, and we might actually have somebody on the wall go get that industry data versus talking to that person directly.
I know you said you look to invest like $20 or $30 million at a time, but what size of a position are you looking to take in companies? Like what size companies are you mainly investing in?
Yeah, we tend to focus on kind of the middle market growth companies. You know, CIB as a whole looks at like $250 million of revenues and above. That tends to be that broadly defined, the middle market growth. So it's easier for me, instead of pinpointing revenues and EBITDA and here's my target, it's easier for me to define it as we focus primarily on the middle market company, the growth-oriented company that we can get in there and provide capital. That's our kind of staple investment, is the growth capital.
So do they come to you looking to sell, or you normally go to them looking to buy, or how do you guys like that?
I'm going to get to that. But the answer is, another positive in Wachovia is a lot of our deals come internally. The M&A group and the FSG group and the corporate finance group. The corporate finance, your debt providers, aka bankers, they're out there at the companies all the time. You know why? They want to make sure they're getting paid. And nothing's going out there that's going to cause that loan to go bad. Because you remember we talked about incentive plans and compensation? That's not good. Not good if your loan goes under. So our corporate bankers are out there all the time, relationship building. FSG professionals are out there as well. And a lot of deal flow, and I say a lot, probably on average 30%, just comes from bankers out there in the marketplace at companies bringing opportunities to capital partners. And you know what? That's 30% that actually make our cut, where we say, yes, we'll do the deal. There's a lot of other ones we say, too small. Because remember, what we've learned is it takes just as much energy and attention from a partner to do a $5 million investment as it does to do a $25 million investment. And so it comes that way. It comes from cold calling. We have niches, industry niches that we identify each year that we like to try to get more expertise in. We may do cold calling, and do not underestimate. So I got another 70% to account for there. Relationships. Relationships with other private equity groups. Our investment professionals know the private equity group's a pretty small arena. It's who you know. And you'd be amazed, a lot of times I go and I speak at private equity conferences of CFOs and COOs, and it's like a feeding frenzy, because we all get in there and we meet with each other, we have the same issues, and it's the same names out there, and the same works on the investment side. It's a lot of times, Blackstone calls up and says, I got a $100 million deal, but I do not want to stick $100 million of my own money. Hey, let's call capital partners. They do energy deals. They might want to get in for $20 million. So no, I still got $80 million if I'm Blackstone. Let's call Bank of America. They might want to put in 20. They've got some, that's how it works. A lot of people, it's who you know. And it works both ways. Wachovia gets deals. Somebody asked me about lead versus co-lead, Wachovia gets a deal, we don't want to stick $100 million all, I've told you our investment kind of size that we prefer is 20 to 30 million. Most companies need a lot more than that. So what we do? We call up our friends. These guys are really good in healthcare. We had a good experience with them on this deal, this deal, this deal. Let's pick up the phone to them and call them.
Tracey, you talked a lot today about, there's been a lot of discussion about this Chinese wall, and it sounds like you guys at Wachovia are very cognizant, and I'm not sure if it's out of fear or just that's the way you do business, but what do you think when you see, Frank Wachovia? I mean, that's the antithesis of this. He just completely blew through all that stuff. He made hundreds, maybe $1 billion, who knows, and he's going to walk free.
Yeah.
Nothing.
My statement to that is, starts at the top. Sarbanes-Oxley, in my opinion, and all compliance and regulations are really only as good as the people behind them, And you develop a culture. Now, Wachovia, we're not just scared. We're respectful, because the tone comes from the top as far as, and nobody from Wachovia wants their name published in the paper for having an SEC investigation or any other kind of impropriety as it relates to a market transaction. And we have to do things, simple things. We have to attest we've read policies and procedures. We have to attest we understand, security rules. If Wachovia Capital Partners is not part of Wachovia Securities, if you're a member of Wachovia Securities, that's a whole nother, your Series 7's license, et cetera. You got a whole nother set of attestations. And that's one of the things we have to do constantly, attesting, and you breed a culture. And I personally think, if the CEO at the top wants to start doing things, it's up to people to either say no, or what happens is, they breed a culture of, it doesn't really matter, just do it this one time. And that's not how we operate.
But the disturbing thing about it is it seems like
Yeah, you know,
not following these rules, Dave.
well, I would tell you, that, you look at, Enron, you got to have a heart attack and got to get out of that, and, really, he kept the money. His family still got it. They're fine. You sit there and you think about people with no pensions and that kind of thing. In my opinion, it comes down, you can have all the rules in the world, and anyone in here who's an accountant who passes their CPA exam will be required to take ethics courses now on an annual basis. And the subject that always comes up in those ethics classes is, can you really teach ethics? I'd say no. It's something, yeah, you can breed a culture, but you gotta say, yes, this is right, or no, this is not right. And that's I can't really make a statement about whether or not the federal prosecutors actually follow through and make somebody pay for their crime. But it is disappointing that just a few bad apples wreak havoc on the rest of the industry, which is really the Enrons and folks like that have done.
Positive side, apart from avoiding litigation and merit, you describe the community you're involved in, private equity. To the extent that you adhere to those rules, you're going to have a lot more friends at other private equity shops that are not affiliated with the bank, because they're not going to go, oh, well, if you get involved with Wachovia, they're going to tip the deal to the investment bankers,
Yeah.
they're going to tip this, or they're going to do that, and you're going to get screwed when the day is over. So, to the extent that you're honest and forthright and do that, it's going to help.
Absolutely. I can't underestimate, and I mentioned this earlier, the relationship. If you're a private equity guy who kind of turns out to be you're going to stab somebody in the back at the end of the day, that group's not coming back to do a deal with you again. And we've had that. We've had where we've been the recipient of the knife and somebody just did something wrong at the end of the day. I'm telling you right now, they're off of our co-invest list. That's not a group we're ever calling back and doing a deal with. And that also works the same with management in companies. If we work with management teams, and we did a deal, I guess it was last year, CEO got into some gambling debt, having problems with his wife, took the capital that was being provided and, started skipping town. Said we were supposed to go for a meeting to go review some bank statements, things like that, and he said, oh, my son's been in a car accident. So meeting got delayed. Okay, we're ready to come down now. Oh, my wife's been in an accident. I mean, literally, this is true. And it got to a point where we said, something isn't right. And we went down there, and it turns out he was stealing money. And, this was somebody who I'd say got himself in a bad situation. And if you ask me what was the most critical thing we do on a deal is the integrity of the management team. The management team is by far the most important aspect of our due diligence process. And determining their core values in prior experience, their philosophies. We do psychological studies on management teams to make sure they are prepared to, are they teamwork oriented? Are they smart oriented? What are they willing to do or not to do?
Following up on the positives of Sarbanes-Oxley.
I'd love to find one. Sorry, that was ugly.
How many deals has the Liquidity Capital Partners done, of small cap firms that have gone private because of the high compliance costs of Sarbanes-Oxley? Looking at Sarbanes-Oxley as a disincentive for small cap companies to remain public.
None yet. But what it has done is we've had small companies that have wanted to go public and were not Sarbanes-Oxley prepared. And it has delayed that IPO process because they're not there.
Just to follow up, though, along that line of thinking, though, has deal flow for other private equity firms picked up because small cap companies are going private due to the compliance costs?
Not to my knowledge that that's been a big driver of deal opportunity. Absolutely, there's some people or some companies that are going private as a result of the complexities of Sarbanes-Oxley. Sarbanes-Oxley, from a theoretical perspective, is right on target. From a practical perspective, when you're out there in the industry and you're applying it, it makes a ton of work that I'm not sure adds a lot of value in some regards. And so there are companies out there that are going private. We haven't had anything in our portfolio where anyone has been public and gone to private from our portfolio, specifically to avoid kind of Sarbanes-Oxley. Most people go private because there's some kind of incentive to keeping the profits to themselves, growing the business and bringing it back in-house to a small group of investors. Okay. I think the only other thing I wanted to say on this slide was just how do we serve our clients. And, we serve as their advisors. And I mean that in terms of when you become a investor in a company, you're part owner now. And you are there a lot of times to tell them, how do we get our company to the next level? What do we do? I'm the CEO, and I want some of my money out of here. How can I do that? I want to go public. How do I do that? I mentioned earlier we take board seats to protect our investments. You serve there as a governing body to help make decisions for the company to take them to the next level. And a lot of times we assist in management, and I do not mean that necessarily on a direct basis. We're there sometimes. CEO's got problems, i.e. he's not performing. Guess who they call sometimes to say, we need to fire the CEO and get a new one. Hey, capital partners, we think you need to go talk to the CEO, let him know it's time to step down. We've done that. We one time had a CEO that just had a drinking problem and was just out of control in social settings. He was a really strong, positive role model for a while, but just kind of declined over time. And he was becoming detrimental to the reputation of the company. And we said, it's time to step down. Guess who got to have that conversation? Our partners. That's some of the things you don't think about when you're going into private equity and doing deals. What that really means in terms of getting involved with your company. Investing capital. What's involved? Okay, so we're starting to get to the point where you're probably interested in terms of, I'm a graduate thinking about an investment banking track or some type of CIB track. When you're in private equity, first you got to set some parameters in terms of your strategy. Raising capital. I mentioned earlier that as an institutional firm, that means we're part of a larger institution, a la Wachovia. We don't have to do any capital raising. But if you're a standalone firm, you go out and you raise capital. Maybe it's $1 billion, maybe it's a couple $100 million. And once you spend it, you got to go out and raise your next fund. Otherwise, you don't have jobs in 10 years. So, that's some of the pros and cons of being with this goes back to your tracks. Do you like marketing? Do you like trying to sell yourself? You might like better being on a standalone firm that's part of their, protocol. Investment pipelines, where are the deals sourced? I touched on this earlier. Internally, that's about 30% for us. Other areas in CIB and the bank. Other private equity firms, critical relationships there. And personal marketing is just the cold calling, making a point to go out and visit with companies. Determining the investment profile. Where do you want to invest? Domestic, international. There are a ton of firms out there that are going international that have actually set up offices. London, Asia. Anyone in here bilingual? You may want to be in a place where you can go abroad and utilize a resource you have like that. Capital partners, we are strictly domestic. We only do domestic investing. And that's something as you're thinking about where do I want to be, you should look at firms that offer opportunities. If you're somebody that wants to be abroad, there's a lot of way to get there. Our fixed income group is just expanding over into Europe and Asia. If that's something that sounds really exciting, living in Asia for 2 years, doing a stint over there, that's an opportunity. You wouldn't want to come to Capital Partners. We're in Charlotte, North Carolina, and that's it. Investment size, we already talked about, is just determining, what are your parameters in terms of the size of the deals you're willing to invest. And, what comes into that investment size is risk, because when a deal goes bad, it hurts when $30 million has to get written off the books. That's part of what's in our thinking is, if anything happens here, what kind of tolerance level do I have for a full write-off through the P&L of a public company? Transaction types, leverage buyouts. This is when you basically use debt to buy a majority of a target company's equity. Recapitalizations, a lot of times those are done when there's an owner who wants to get some liquidity but still wants to retain either management or ownership type control. A lot of times we do recaps. That's been the name of the game in the industry right now, recaps. Because when debt was really cheap there for a while, interest rates were really low, go out, pay off that subordinated debt, which had like a 16% interest rate, with some cheap senior debt. Boom, your equity guys are out, senior debt's in, and that works great as long as you get your debt paid off with sufficient cash flow. Corporate divestitures, that's just, that kind of ties in with our M&A. Sometimes there are people or companies out there looking to sell off a piece of their business. Needs a buyer out there who needs capital to do it. Acquisition capital, that's another, what I tell you is a prevalent area of where we invest capital. Companies that are looking to do acquisitions to grow their platform. One of the things we do not do as a group, we do not do what I truly call venture capital. That negative cash flow. Still looking, we did that .com, and we said we never do that again. So, but we do invest in small growth companies that are looking to grow through the synergies of making acquisitions. And then growth capital for established companies. Again, that's another providing working capital to a company that's trying to take their business to the next level. And special situations, that's predominantly distressed investing, which we really have not done as a unit, but there's some firms out there that really target the distressed, companies about to go bankrupt, go in, kind of buy their stock at a cheap price. When you really see even though they're in bankruptcy, there's a lot of value there. If you could just get the right management team and refocus the company, you make a lot of money there. You got to determine the role of the capital provider. Do you want to be control, meaning I refer to that more so in ownership position. How much of the company do you want to own? Lead investor, which basically means, hey, I'm the equity provider calling the shots around here as far as who gets to invest, who doesn't. I usually have the biggest piece of equity. And one of the things sometimes we do is, this goes back to the relationship building. We'll go find another private equity group who we really trust and thinks like us. And let's say, I'm going to use this as a bad example. Let's say Bank of America wanted to put in $50 million, but we only want to do 25. They're like twice as big as we are. But we're really good friends with J.H. Whitney, and they said, well, we're willing to put in 25 too. We might go pool our money with them, and now we have $50 million and have the same benefit of, from a purchasing power perspective in terms of leading and a deal, co-leading a deal, which is really the co-investor down there. Minority investor is really when we make an investment. This is probably the exception more than the rule. Sometimes we'll make an investment in a company for relationship purposes, but we have such little ownership that we really don't command any kind of ability to kind of influence the deal. We're basically a passive investor. I don't know if anyone's seen the HCA transaction, where they're trying a couple $1 billion there. A $30 million investment on a, mega deal that size doesn't really result in a lead or control type investment. Security types. I think I mentioned this earlier. If you recall when I kind of talked at the beginning about just the capital structure and what we provide, subordinated debt is just what it sounds like. It's kind of a debt type product. It's subordinated to the senior debt. And the one thing I tell you that's a little bit different that makes it more of an equity product is 99% of the time they're not cash pay. So when we give you debt, the reason you come to an equity provider, we're expensive, but you don't have to pay us anything right now. All our money's at the end. So when you're a cash flow struggling business, and you can't afford to make principal and interest payments, your equity provider becomes much more attractive, but you're giving up ownership, and that's what your constant challenge is. Redeemable preferred, again, we're kind of in that mezzanine level. It allows the company at some point to redeem the security. Remember I talked to you when debt got cheap and we kept getting paid out through recaps. That'd be the type of security that would allow management to redeem us and pay us off. Usually there's a penalty to that, which helps us make money as well as warrants. Convertible preferred, that's a fancy way of saying kind of senior common stock. What usually happens is we invest in a company that's in a smaller stage of life and working on growing the business. And so we have a choice. It's usually got a stated rate of return, usually about 8%. We can take our interest payments at the end, or we can forego the interest, convert it to common stock, and take an ownership position. And a lot of times, if we're successful in growing a business, that ownership position is worth a lot more than just the stated rate of return on the security. But in the event a company is struggling, that stated rate of return provides us minimum return and makes us senior in the equity structure. So it costs a little bit more for us. And then common stock is pretty much what it is, common stock. And the only other thing that I tell you is not on there that is similar is a lot of times we invest in LLC type interests, which usually take the form of common or preferred stock, just in a fancier way.
Along that line, do you get involved in any tax credit deals with like a nonprofit organization, development deals of real estate or the like?
We don't. Our real estate capital markets group does, and some of our other areas in fixed income. They do the tax credit type investing. That's, those are the slight nuances that put you into different boxes. We do not do the tax advantage type products. All right, so moving along to doing the deal. This is just kind of a quick overview as far as how does the deal get done. We do what's called a whiteboard. And I notice there's none in here. I guess in this case it would be called a chalkboard. The whiteboard is putting it, I'm a partner. I've got an investment opportunity I think looks pretty good. But I want to take it in front of my other partners and get some feedback. Maybe I want some thoughts about how would I structure this deal in terms of what type of securities would I want to create. Is this an industry we think is actually viable? That's the deal worth pursuing. Put it in front of my other partners, get some feedback. They usually ask a lot of questions. Which goes down to my next bullet about due diligence. That's how you go. That's the phase where you go and answer all those questions from the other partners. And what I said earlier is during the whiteboard, where's the capital coming from? Hey, does anyone know another private equity group that might be interested in doing a media communications deal for CLEC? Oh, J.H. Whitney just did that, and they have a guy there called John Brown, and he'll put you in touch with the guy who did their last deal. So the whiteboards is really nothing more than the kind of the internal initial vetting. Do we want to spend our time doing this deal? Because the due diligence is time consuming. Our deals take on average, to get one deal across the transom, on average 6 to 12 months. Our average deals probably per year, we only do about 10 to 12 max. And that's a lot.
How many deals would you look at to get to that?
Really look at? Because there's the, no, we're not going to do it. That's a ton. There's the, went down a path. There's probably another 10 at least that's the, look at, pass. I'm probably understating that to some regards. Every Monday we sit in a group wide of just what's in your pipeline, what are you looking on. There tends to be 2 or 3 deals and on every industry group, and it's kind of we tried that one, we lost it in the auction, we passed, something like that. So there's probably, for every one that gets done, there's probably at least 1, 2 that.
Can you give us trying to figure out what passes that test, can you give us an idea of the crazy things that you've heard that haven't passed the test or some that do? I mean, what are you guys looking at?
Part of it is size. We don't spend, I can't tell you how many times. Wachovia is listed on, we have an actual small business investment company vehicle, which in the olden days was the only way you could deploy large equity positions because as a bank you were never allowed to take more than a 5% voting ownership. So the SBA came up with this vehicle, the small business investment company, that says we understand sometimes small dollars can equal a big ownership position. So we'll let banks like Wachovia put their money in and maybe take a voting ownership greater than 5%, and we're okay with that. And so we used to do much smaller deals through that, and we're still published. Every day I bet you I get a phone call. Hi, I'm looking for a $700,000 loan to finance my vacuum cleaning company. You need our small business lending group. You're in the wrong place. So a lot of it has to do with size. Okay, we don't look at the $5 million deal anymore. You need to be in the $20 to $30 million investment range. Some of it has to do is it's too risky. .com type venture capital, not in our appetite. Some of it's in industries that we don't feel like we have expertise. We might pass. So there's a myriad of reasons. More times because it's just outside of our stated investment parameters, not because it's a crazy deal.
Yeah. Do a lot of the times the deals resurface and then you come back and like they'll come back and you can negotiate the terms?
No. A lot of times what happens is if it's truly a deal we like, we would do a letter of intent and put some terms out on the table, and you'd negotiate around those terms in terms of what's acceptable. That happens, recutting the terms, but you know whether or not you like or dislike a deal pretty much from the get-go.
Because your reputation as a Wachovia, you sometimes like get deals because it's somebody smaller or whatever, like trying to get the same deals.
I would say yes. In summary, it goes back to that networking relationship we have. You know, we just have a lot of people out in the field with the Wachovia name behind them, so that's beneficial to us. I can't underemphasize the relationship aspect. We have investment professionals that have on average 15 years of tenure. They know the top guys and all the other top firms. That has more to do with it than anything. You invest with who you know, and so it's harder to go to the private equity shop that's just starting up their fund than maybe somebody who's been around the block for 15 years and knows what they're doing. So kind of continuing through, we move into the due diligence phase. I think I mentioned it earlier. Due diligence is due diligencing the management team, doing your industry research, understanding the prospects of growth for this for the company you're looking at, doing the cash flow analysis and modeling, and making sure you know at the end of the day how you're going to get out of this deal. That's part of the due diligence as well. It's got to be a company you think maybe at the end of the day becomes a strategic fit with somebody out there that you think would buy the company. You can take it through an IPO. Do you have a question?
I wanted to ask you actually about the management team. It keeps coming up over and over, the importance of the management team. Does it ever happen that you'll meet a management team you really like in a certain industry, and they might go from company to company? Does that happen when you follow these
Yeah,
management teams?
we have done, and let me see if I'm answering your question correctly. We have had managers in companies, let's say a communications company, who were rock stars. And they sold the company, and they made multi-millions, and now they're just kind of sitting around. And then we have this other company over here that's in need of a new CEO. Absolutely, we'll go back to the CEO and say, you got any interest in coming and managing this company for a while? And we will grab a proven manager like that.
Does it ever happen the other way? There's like a manager who's worked with you before and it worked out well, and then that's kind of what he does. He finds companies and he tries to get in a position where...
There are people out there whose sole purpose is to be that interim CEO. Is that what I'm?
Yeah.
We have actually, and we've used them before on our deals. The gentleman's job is to be an interim CEO, not to stay there full time, and he's just there to keep the company, get it going, while we're doing our research to find a CEO. Not often do we invest in a company that lacks a CEO from the get-go. But you might have a CEO. We've had scenarios where got in a car accident, for some reason, is leaving because just had a baby and his wife wants to move back to Kansas. And, it's, what are the reasons you might leave a job? Same reasons happen at the, CEO levels. And you remember, a lot of these companies are, smaller growth companies. It's a lot of work. A lot of work in growing a company. And you can make a lot of money at the end of the day from it, but you're going to pay your dues, there. And, some people say, I've had enough. So it's not always a bad reason that you might have a situation where you got to have an interim CEO or CFO, you'd hope. And the one thing I want to say is, as you think about you coming out of school as graduates, this due diligence phase right here, consultants are doing the management team, interviewing as well as the partners. You, as an associate/analyst, would be doing the industry research. You would be doing the cash flow analysis. You would be doing the market data analysis. And then you redo your modeling about 30,000 other times as the partner tells you to rehash the numbers with 40 different scenarios. And, the woman I told you that we just hired as a gator would tell me stories. She actually worked on the corporate finance side. And she'd tell me stories where, she'd help with the pitch book, she'd help do the modeling, They get it all done, and then it was oversubscribed, so they had to recut all the numbers a different way. She goes back to what she did. They redo it, and you do that over. Your copy person, your industry research person, you are the nuts and bolts, and you're doing all the work for the partner to analyze the deal. The associate role in private equity, or even analyst or associate role in another group, is that's your learning ground. You are the bottom of the totem pole, and that's exactly where you learn the business. And you start, who was it that asked me, how do I know where I want to go eventually? Sometimes it's getting in there and doing it, and you become more exposed, and you see different areas of, wow, I really like healthcare. That's interesting. Energy. That's and you try to find ways to set yourself up in positions where you can target your interest towards something you want to do. All right. Moving down to the closing piece of it. Once you've done all your due diligence and you say, okay, I want to do this deal, then there's another, what seems like months worth of, we got to go through pre-approval processes, making sure we don't have any conflicts of interest. You have to get all the legal documents pulled together, and the hashing back and forth to make sure everybody's in agreement. That takes a couple of weeks, and then finally they're ready to fund. At that point it would come into my shop. They're ready for the money to go out the door, get it done, and we handle all that documentation. A lot of times I've closed deals on behalf of partners who are out of the office. The attorney knows to call me, tell me when to fund. I got to sign documents. Kind of do the final touches on an execution once the partner's taken it 99% down the field. Portfolio management is when the deal's done, we have an investment, and then we just got to monitor it, whether it's for compliance reasons, accounting, management reporting, tracking our diversification. I put there industry diversification. That's huge for us. We never want to make sure we're getting that happened to us in the .com. In the .com world, we were way too heavy on telecom. And that's a big point for us now, is tracking how much do we have invested in each type of industry to make sure we've kept a balance there. But portfolio management is literally just constantly monitoring the investment from a Wachovia perspective. Okay, so that's internal, versus the next bullet, which is relationship management. That's the partner. That's the constantly checking in with the company, making sure we know what's going on there, going to see the company. In our shop, we tend to take associates out with us to give them exposure to clients. So a lot of times you get to go to board meetings. You get to meet with the clients. Sometimes that's golfing. Sometimes that's just going out for a visit. And then as our associates are responsible for doing every 6 months, you got to do a valuation and write-up. You remember I talked about that before, kind of justifying the carrying value of the investment. That's, again, the associate role, working with portfolio management to make sure we have all the valuation analysis behind each of our deals. And then realization/exit analysis is really, we've got this deal out here, and once you reach a point where a company has gotten to a significant growth stage and our money is worth a multiple of its original value, how do we get out? Time to monetize. All right, we got an IRR out there, right? Kicking along. The longer it sits out there, the more money I got to make to achieve that hurdle IRR. IPOs, secondaries, and that's, somebody asked me earlier about, public stocks. We sit there a lot of times with huge positions in public companies. We just can't move. That's a lot of times where I talked earlier about helping a company make, advising them to do secondary offerings as a way to add more liquidity to the stock, get us out, of some of our positions so we can start to liquidate. That realization exit analysis is a huge process. It's not just, let's sell a company today. I mean, it's months of work, and it's having the foresight to figure out how you do it. An IPO, a sale, a recap, etc. Okay, so the deal team, I put et al. Because everybody kind of works together in a private equity world. There's the true deal team, which is your front line. Partners, principals, vice presidents, associates. One of the things I want to point out to you is there is no analyst title in private equity. That's because there is, at Wachovia Capital Partners, there is no entry into private equity directly from school. We only hire associate level professionals who have already had at least 2 years of experience in some other line of business, predominantly mergers and acquisitions, corporate finance, but I won't say only, okay? And the way we usually get them is through internal recruiting at Wachovia, but a lot of times we go out to other businesses.
Why is it exactly that, because most private equity companies don't hire people that have less than 2 years of experience. What is the exact reason they do that?
Most of the reason why is, this is my statement, is the pace of the business and what you're doing is you want people you can take out there to the client. You want seasoned professionals. We really don't have the tolerance from a pace perspective of helping young professionals cut their teeth. What they want is they want the graduates to cut their teeth in a different area, and there's 2 reasons for that. One, you know how to do everything. By then you know how to model. You get cash flows. You're savvy with meeting with customers. You have more of the experience, and that was my second point. Is 2, you're seasoned enough to add more value. That when you come onto our team as a associate, you're not sitting in an office. You're getting in a plane. You're going out to companies. You're going out to board meetings. You're doing analyses. You're doing the projections. And I think this is true in the private equity world in general. Unlike some of the other areas, in the other areas, the analyst position tends to be more of you're in the office doing more of the behind the scenes. You may get out to a client periodically after you've done 2 months worth of work. Maybe they'll let you go to the closing meeting. The way we run our shop is it's much higher level. We want you out there, we want you to get a diverse experience, we want you out meeting clients, and the knowledge base you get from being in corporate finance or mergers and acquisitions is beneficial to the private equity business line. So it's usually what happens is it's the experience you get at those levels that helps you be more thoughtful and better utilized at the private equity level. Does that make sense for you? So anyways, the principles are pretty much the same thing. Don't tell my cohorts I said this, but I call them kind of junior partners. They're the partners. That's your line of succession there. We have managing partners who are the top dogs, the guys who have been around forever that run the business. We have partners. I am the only partner at Wachovia Capital Partners that is not frontline partner. The principals are the partners in making. Post-MBA students who are working through the ranks they're in the carried interest plan, but they have not achieved the tenure yet of partner. Vice presidents and associates are below the carried interest line. The vice presidents tend to be your professionals on their way to business school just before going to get an MBA. Very rarely for the individuals who we allow to stay without an MBA, that would be your vice president level. And then your associate is the 2 to 4 year tenured professional who does not have their MBA. And let's see if I had anything. Then we drop down to the middle office level. That's really my world right there. We're called middle office because we kind of sit there in the middle. We still do a lot of work with the deal and the deal professionals, and then we also liaison to that back office list that you see down there. And the reason I put CFO, COO, CEO, you'll find in the industry different titles are used in different ways. It's that I call it the person who is the go-to for like running the entire business. If you went to my managing partner today, he'd tell you I run his business for him, so he's doing the deals. I do HR, finance, accounting. I help associates with valuation decisions. I may help close a deal at the end of the day. I may process legal documents. I may work on compliance work. And part of the balance I have is being able to talk all the languages to all the different areas. And then your back office is truly the people that don't have anything to do with the business unit per se, in our shop, they're the support. We call them business partners. They're the service partners. They're not actually part of the business unit, but we have to work with our finance, accounting people to make sure once we get a gain. I always tell people it's not a gain until it's recorded into the general ledger. So we work with our finance, accounting, our marketing, HR, legal, compliance. I mean, it's a lot. So when we talk about pros and cons between standalone businesses and financial institutions and those kind of things, there's a lot of work. One of our pros is we don't necessarily have to go out and raise capital unless we want to. One of our challenges is because we are in an SEC regulated environment, which happens to be a financial institution, there is a ton of compliance and regulatory needs that we face that a standalone private equity firm does not. And in a standalone private equity firm, some of these functions are actually part of the business unit, whereas in our case, they are not part of the business unit, but being associated with Wachovia, we're required to liaison with them and make sure they have what they need. That middle office does that speaking between the front line and the back office to make sure everything gets done that needs to. And one of the things I would tell you just from a professional standpoint and kind of looking at what's available is, there's a lot of glass ceilings in there. One of the things about private equity I can tell you is it's a highly compensated world, and people don't want to leave it once they're in it. And, I think somebody at one point had asked, when I mentioned about management sometimes, gee, is there a track where I could go work in private equity and then go be CEO of some firm, some company that's in a growth mode firm? That usually doesn't happen in the private equity world because the compensation being on the private equity side is far greater than the compensation of being a CEO of a company, especially a growth company that's still trying to work its way out. Not to say it doesn't happen, but in my experience, it's been at that VP principal level where somebody has decided not to go back to MBA school, instead ventures out to try to find another opportunity, sometimes in industry. So just FYI. All right, so how do I get a career in private equity if there is no path into private equity per se? I kind of gave you my career line and how I got to where I was. One of the decisions you need to make here, and there's not that many accounting professionals in here, but I said, when I was coming out of school, I had, public accounting was all I kind of knew. Make your decision, if you're accountants in here, of whether or not you truly want to stay on an accounting track or whether or not you want to be more of a finance track. And the way I differentiate that is mentally, I tend to think of accounting as more of that back office or middle office. I tend to think of finance as more of the associate type, analyst associate type process where it's front line. In the event, depending on which track you pick, we talked about this at lunch, a CPA designation or an MBA or a CFA designation doesn't necessarily mean you are the top dog of the world, but it does look good on a resume. And when you're out there marketing yourself, when you come right out of school, the first thing somebody's going to look at, and I can tell you because I did this on some resumes, GPA. That's your first, GPA is the first designation that you have coming out of school. And I was telling some students earlier, the next thing you look at, GPA with extracurricular. Can this person be a leader in organizations, have community involvement or social involvement, and still have a 4.0? Or are they 4.0 and does absolutely nothing else? That's, and so the CPA or the MBA, I think, are kind of minimum requirements / designations. That's the first step of showing some of your core competencies as what you're capable of. Once you're out there in industry, like I have my CPA license in Florida and North Carolina. I've never used it, but except for a website. Because my partner likes to be able to put out there that I am especially when I had the CFO title, he likes to put out there that I have a CPA designation. The same thing for associates. Our associates are hired, and make sure you're clear on this. When you come into a private equity group as an associate, you're given a 2 to 3 year tenure and then you're kicked out. That's not a very nice term. Then you're told you're to go get your MBA, and your job isn't waiting for you when you come back. So the private equity world is a transitional world. So you come in for 2 years, and the reason why a lot of students like to do it is it's a great resume builder, just like the designations. You need to go out and get your MBA if you want to get to a partner level type position in private equity. Okay? You go out and get the MBA. A lot of people then try to find another private equity firm to get into. Sometimes your job's waiting for you when you get back, but it's not always a guarantee. And then you start climbing the ladder again in terms of trying to get up to the partner track. The importance of prior experience, I think we've kind of touched on that already. It's just, you can't enter private equity directly. So if you want to get into a private equity type career, you've got to have an experience that is considered synergistic to making that happen. So that's something in corporate investment banking, I'd say predominantly investment banking. And then, pros and cons of each track. I do want accountants in here to realize that you can be a deal professional as well. That's an option. That's a track. But there's pros and cons to each. When you get out of school, if you're going to be a true success, I guarantee you're going to work harder than you ever realized. You're probably all studying for exams till 4 in the morning and things like that. You'll be doing the same thing, only you'll be doing cash flow analysis. When you walk in, it's about making a name for yourself. Your work ethic, your attitude. You're out there with a bunch of type A, highly competitive, just as smart individuals, all trying to get to the next step. And you need to decide for yourself. We were talking about, are you an introvert? Are you an extrovert? Do you like to, interact with new people, learn new businesses? If it's, find out what your talents are and utilize them accordingly. Do you want to be frontline, or would you rather be behind the scenes a little bit more? I call that an industry track versus a public accounting track, a corporate investment banking track versus, let's say, a general bank, wealth management, kind of behind the scenes track. And the pros and cons of each is, when an associate comes on board in private equity, there's a lot of travel. Like on average, I'd say the partner level is probably 4 days a week. And those are day trips back and forth, which sounds not so bad. It's a long day. I can tell you, I flew in this morning. I'm going to fly back tonight. Up, down, straight trip. But my day will be a 12-hour day probably by the time I'm finished. It's a long day. And when you do that 4 times a week in 4 different cities, it's not as glamorous as it sounds. And associates do the same thing. They travel a lot. They work late nights, eating a lot of meals in the offices, that kind of thing. And we talked about, if that's not for you, maybe you have a small child. You don't want to be working until 4 o'clock in the morning. I'd highly suggest you think about a track that's more behind the scenes and internal. Make sure you do that kind of thought process when you're going out there and interviewing with some of the firms that are coming out on campus. Barriers to entry, I kind of mentioned it earlier. No direct track in terms of an analyst position, and everybody wants to get into private equity. Everybody. Our group in Wachovia is. I remember when I got hired, the first question people said to me, and a lot of this came from the independent accountants, were, "How did you get in? How did you?" To some degree, I was in the right place at the right time. I was supporting the group that I ultimately ended up working for. But I'd like to think at the end of the day it had more to do with the service level I was providing, adding value to the group, and having a drive to work hard and help the business grow. So that's just one of the things I want to make sure you're clear on. And then working for portfolio companies, I kind of mentioned that. You might be sitting in here today saying, I am going to be the CEO of the next company that is created, or the CFO for that matter. Easier said than done. Everything requires a, pay your dues. You're going to start at the bottom somewhere, and opportunities are going to arise, and you've got to take advantage of those opportunities. And the best way you can differentiate yourself is through your attitude and your work ethic. That does not mean running over people. That doesn't get you anywhere. It means shining on your own accolades, not putting people down to make yourself look better, just being good at what you do. And it goes a long way. So, my top 10 things graduates should know before pursuing a private equity career. Know how to use an HP calculator. I mean this with all seriousness. When I was in Dr. Brown's class, and if anyone of you didn't know this, he was my graduate finance professor, we had an option between using the HP calculator or getting like the Casio finance calculator that worked. And a lot of people would tell you, you got to think backwards using the HP. Get the HP. Learn how to use it. Every partner I work with uses the HP. You use them every day. I can't tell you how many times I've talked to a partner, hey, we got a deal closing, might get it's valued at this, it might be worth this. I mean, the first thing they're doing is getting on the HP, calculating the IRR and what the gain is. It's an everyday part of life. IRRs and present value calculations, when Dr. Brown's teaching them to you, actually listen. You'll use it again, no matter what career path you probably take. Number 9, learn from your mistakes and never make them twice. One of the things you should appreciate is when you get out into the career field, you're going to make mistakes because you're learning. You haven't been out there before. Everybody knows that. But once somebody explains to you what your mistakes are or is, they don't expect to see them again. So make sure you make your mistakes, you accept them, own them, and learn from them. And then don't let them happen again. Number 8, be able to speak all languages. Do not underestimate the value of knowing the terminology in finance and accounting. And then investment banking just has some code language. That's kind of like what we talked about. Know what subordinated debt is, know what capital structures are, et cetera, et cetera. But I can't tell you how many times, when you're doing a cash flow analysis and you're trying to model out, okay, I'm making some growth assumptions about a company, you got to understand how the balance sheet and income statement work together in order to do that modeling. When you're making different assumptions about depreciation and taxation and things, etc. You must make a name for yourself somewhere other than private equity first. So, if you want to get into private equity, find a track that gets you there. It's going to be in one of those other boxes, like I said. You've got to cut your teeth in a field that I would call is synergistic to the private equity world. Number 6, competition is fierce. You and every other college university that has a group of professionals such as yourself are out there trying to get the same job. There are a lot of smart people out there. You're just as smart, and as Gators, I know that for a fact. Just remember, you got to make a name for yourself. Be confident when you're interviewing. Sell yourself, and know that you got a lot of other people out there who are also trying to make their own impression. Number 5, read the Wall Street Journal or business-related periodical to be familiar with what's going on in the marketplace. One of the things I had to do when I was a student here at the University of Florida was we had to cut out Wall Street Journal articles that related to accounting. I had to find, we didn't have good stories back then. It was, usually something. I thought it was the most painful thing I'd ever done in my life. It was so boring. But what I would tell you is, somebody asked, gee, how do I figure out what I like? Look at some of the transactions that are just being discussed in the Wall Street Journal. A ton of private equity transactions are getting discussed in there. There's actually periodicals related strictly to private equity. It does give you a feel for kind of what's getting done out there in the marketplace sometimes. Just educate yourself. Wow, that is a cool deal. What happened? Was it an M&A transaction? Was it some kind of financing? It may help guide you as far as where you might be interested from a career path perspective. Not to mention make you kind of all-around knowledgeable. Ask thoughtful questions. It shows you are confident. Bet you don't do it. The best thing you can do for yourself when you get started, once you've gotten the job and you're in there, ask questions. You're never going to learn if you don't ask questions. And you know what? When you ask a question, you're admitting you don't know something. And I know because I did it, you think you're supposed to know it all when you get there, right? You're graduate students, you got your GPAs, you should know it all. Just make sure you're asking thoughtful questions. Have it explained once and learn from it. Because one of the things I've always said as a manager is when somebody asks me a question, I realize they're thinking about what they're doing. They're not just doing it. So while you may think, and don't start your question with, I know this is a stupid question. That is my pet peeve. Just start it with, I have a question, explain to me why. And what it shows is you're thinking about what you're doing, and you'll actually have more credibility with your managers because they'll know you're actually thinking about what it is you're doing. Learn to play golf. Ladies, I do not know how to play golf. If there's one thing I said I wish I had done in the University of Florida, it was taking the golf program. I did aerobics instead. Golf is not required. Remember I told you about differentiating yourself? Golf. Particularly women here. If you can golf, you are a notch above every other woman who's out there. And I don't play golf. And every strategic outing that we have, it's golf related. Guys, if you have a great golf game, you'll become instant pals with the top brass. And I say that seriously. So much gets done from a social perspective. We have a lot of law firms that take us on outings. Golf. We do strategy sessions as a group. It's golf. So I know that sounds kind of crazy. It would be one of the best things you ever did. And it's twice as hard to learn once you're out. Because once you're working and you're staying up till 4 o'clock in the morning crunching through cash flow analyses, you don't have a lot of time to golf. So never miss the opportunity to impress someone with your ability, drive, or character. People will help you get to the next level if they know you to be reputable. Now, I like to say that in short term, which is it's not always what you know, it's who you know. And we talked about making paths for yourselves and finding opportunities. When you're out there showing people you got what it takes, the drive, the attitude, the initiative, and I learned that about you, it's amazing kind of what value that can be later on in life. When you are going out to get your MBA and you call up that managing partner and say, hey, got anything in your shop? I'm graduating, I'm looking for that next position. He may not have anything in his shop, but he's willing to make the call to his buddy over at the other place because he's worked with you and he already knows what you're capable of. Don't underestimate the importance of that. The other thing I would tell you is don't underestimate the importance that you're playing in these institutions as a Gator. How you perform will directly result in a perception at that institution of what it means to hire a graduate from the University of Florida. If any one of you ends up at Wachovia tomorrow and you totally failed, you will jeopardize the perception of recruiters coming down here again and hiring from this university. On the flip side, which happens to be the case right now, the other Gators that have gone to Wachovia have been awesome. Once recruiters start realizing there is a talent pool that they have not tapped into completely, they're going to come down here again looking for more of that same talent because it shows that the University of Florida is teaching core competencies in terms of equipping students with what they need to be a success out in the business world. And that is something I want everybody in this room to take seriously. I am working very hard as a result of coming here to speak today of making sure our recruiters in that CIB box particularly are coming down to the University of Florida. And one of the mandates I have is, the minute they heard I was speaking, here are the positions we have open at Wachovia. If you meet anybody, let us know. Number 2, okay? It's make a name for yourself. And it's remember how your impressions count way into the future. And the last thing I want to just tell you is the world is your oyster, but success comes from within. Drive, attitude, work ethic are a must. No pain, no gain. That means when you're sitting there crunching through models and the managing partner's gone home to be with his kids and have dinner at his table and you're eating your seventh day of McDonald's because that's the only restaurant in the bottom of your building that delivers. Your attitude, how you get stuff done, timeliness, execution without mistakes has a critical factor in terms of your success. A positive attitude cannot be underestimated. Nobody, when you're spending those kind of hours in the office day and night, and trust me, you will spend more time with your coworkers, at least up front, than you will with significant others in your life. Nobody wants to be around somebody who's a drag. And I always used to say in auditing, when I was with Price Waterhouse doing audits, and trust me, auditing is pretty boring. But when you had a great group of people to do it with, my motto coming out of public accounting was, it's not what you do, it's who you do it with. And when you're working long hours like that, you need people to rally and get it done together. So with that said, that ends my speech for today. I appreciate you all letting me come out here today. And definitely, go Gators. Thank you.